This house in Tacoma, Washington is listed at $525,000, and we're going to walk through a real mortgage quote to talk about how much income it would take to qualify for this house. Because I know that when you're in the early stages of looking for a house, all you have is online calculators and maybe a few articles and videos, and you're trying to put all the pieces together to just get a basic sense of what to expect, of what your numbers are, of how much you might be able to qualify for. And it's really tricky, so we're going to actually, and you just don't know how much you can count on those numbers online. So we're going to walk through a real quote here. I'll show you a real quote that I pulled today on this house so that you can get a more reliable sense of the numbers. And also I'm going to walk through and explain why the numbers are what they are, how they differ, how they might end up differing if they do differ. So you just have a more reliable sense of what to expect, and should get you a little bit more dialed in early in the process. So we'll walk through a quote, and I've pulled obviously how much income it takes is going to depend on how much you have, how much cash you have for a down payment. So we're going to walk through two different scenarios. I've pulled a quote for two different scenarios on this house, one where you have about 5% down for a down payment, and one where we can get up to 20% down. And so obviously pay more attention to the one that is closer to you, but also looking at the other one will help you inform, instead of just an abstract idea of this is what my numbers are. It'll help inform of why your numbers are what they are and how they would change if your cash changed as well. So for each quote, we'll walk through how much your monthly payment is going to be, how much cash you would need all in each scenario between your down payment and your closing costs. And then based on all of that, we'll talk about how much income you would need in order to qualify for the loan in each scenario. Now, if you're wondering how legitimate these numbers are, they are, or it is a real quote that I'm pulling. My name is Landon Buto. I work with Cleveland Street Mortgage, a mortgage broker based in Bothell, Washington. So it is a real quote we're pulling based on live numbers today. That doesn't mean that it's an advertisement. It's not a promotion for the interest rate or the numbers that you're going to end up with. It's just an idea of what you might be able to expect based on certain assumptions if those are close to you. So let's go ahead and look at the numbers. All right, so here's the quote, and on the right is the 5% down scenario. On the left is the 20%, not 25%. 20% down scenario, and for both of these I'm assuming a credit score of 740. You're probably aware that your credit score impacts your pricing, so generally a little bit higher credit score, a little bit better your pricing, a little bit lower, a little bit worse. And a couple notes on that is, one, if you're a first-time home buyer, your credit score won't have as much of an impact on your pricing as if you are not a first-time home buyer. Another important point is that generally credit score impacts your pricing in 20-point increments. So going from 740 to 750 or 745 won't really do anything, but getting from 740 to 760 will improve your pricing. And then same thing going down. So just be aware of that. So let's walk through first the 5% down, and we'll come back and see how the numbers change in the 20% down scenario. So on the 5% down, your monthly payment is $3,999, and that is made of four different components here that you can see. The first is homeowners insurance. That's an estimate, but it is a pretty reliable number, a pretty common number that we see for this price point in our area. That's going to vary. Your homeowners insurance will vary depending on who your insurance provider is and what your coverage is. You can change your pricing depending on how much you want covered. But that is a pretty average, pretty common number that we see. Taxes are $393 per month, and that number is actually drawn from the county website for this property for 2024, so that is the actual number you can expect. And those two components, homeowners insurance and taxes, no, they're not really part of the mortgage, but they do go into your mortgage payment typically. It's very rare to pay them on your own outside of your mortgage payment. It is possible, there are exceptions to that, which you can look into, but most people, it doesn't change how much you pay. It's just letting the mortgage company handle it, and so most people don't really have an interest in that. If you do, you can look into that, but it's pretty tough sometimes to get an exception to that. You typically have to pay it as part of your mortgage payment. Either way, they will be included in the number that is used to figure out how much of a monthly payment you can qualify for. So we'll come back to that later. Mortgage insurance of $121 per month. Mortgage insurance, you're probably aware you have to pay if you put less than 20% down. It will vary depending on several factors. How much your mortgage insurance will vary depending on several factors. One is your credit score, another is your down payment percentage. If you put 5% down, you're going to have to pay more in mortgage insurance than if you put 10% down, and 10% down more than if you put 15% down. Typically 5% increments, so like 10 to 11%, might make a little bit of a difference, but not that much difference. But 10 to 15%, if you can hit that 15% threshold, 15% specifically is a really important threshold. That knocks your mortgage insurance down a lot because it shows the lender there's not a ton of risk here. But just be aware of that. That's how the pricing is impacted. And then it varies depending on your loan amount. Obviously, there's more risk to the lender if they have a larger loan amount. So the cost to cover that risk, which is your mortgage insurance, is going to be higher for a larger loan amount. So this number could vary. If you're at 15% down and you have a loan amount of $400,000 instead of $500,000, that could be $20 or $30 a month. But if you have a loan amount of $600,000 and your credit score is 700 and your down payment is 5%, then that could be closer to $300. So it's just going to vary depending on those factors. And then the last component is principal and interest, and that is just a function of your loan amount right here, $498,000, and your interest rate, 7.125%. Now again, your interest rate is that's not an advertisement for what you're going to get. It's dependent on several assumptions that I'm making about this loan to create this quote, but it is a real rate that one of our lenders is providing, but it's not necessarily available. It's not an advertisement, and you can see the APR here as well, all the disclosures there. So it's not a real. It is a real interest rate, but it's not guaranteed that you can come and get this. But it is a good idea of generally where we're at as far as interest rates right now. I'm making this on May 7th. So 7.125% interest rate. Then down here, I want to point out this section, other closing costs of $11,319. So you need to be aware coming in when you get your mortgage that there are other closing costs that are involved in getting your loan. You have your down payment. Everyone's aware of that. But beyond your down payment, you have to pay other closing costs. And that will vary depending, again, on several factors. But if you're looking at a scenario similar to this, prices similar to this, down payment similar to this, at a time where interest rates are similar to this, then generally we kind of use a number of maybe $10,000 to $12,000. It's getting definitely closer to that $12,000 point now, but that involves two different main components. One of those components is what's called, it's just the costs involved in getting your loan. You have to pay all the people who help you get your loan and get your house. And that's not including real estate agents. They have kind of their own separate deal. But closing costs include your appraisal, your inspection, the escrow and the title company, the loan officer. So different costs are involved in closing costs there. Any points you're paying to reduce the interest rate, or it's offset by credit if you're taking a higher interest rate. And then the other component of closing costs, so that's just costs involved to actually get the loan. And then the other component is what's called prepaids, and that's just a cost you're going to be paying on an ongoing basis as part of your monthly payment, basically. But you have to pay some of those ahead of time. Because typically it takes the lender, they skip your first mortgage payment because it takes some time to get you set up in their system, so you pay some of those costs ahead of time as part of closing costs. So that's what closing costs are. So your closing costs plus your down payment of 5% means in order to get this loan, you'd have to have just under $40,000, $38,764 cash all in. Okay, we'll come back and we'll talk about how much income you would need in order to qualify for this in just 1 second. Let's look at the 20% down scenario. Okay, so I'm not going to explain this one in as much detail. I've explained kind of why things are what they are, but I'm just going to show how the numbers change when we get to 20% down here. Now your monthly payment drops down to $3,348 per month. Now there are three components. We no longer have mortgage insurance because we hit 20% down. So right away that's going to be $121 per month difference. Homeowners insurance and taxes are still the same, because those are dependent on the house, not the loan. So what that means is the rest of the difference just comes from any difference in principal and interest based on a different loan amount or a different interest rate. But you can see down here our interest rate is the same, 7.125, which means it all just comes from a different loan amount, $420,000, rather than the $498,000 over here. So we are paying less principal each month because it's a smaller loan amount, and we are paying interest on a smaller loan amount, so we're paying less interest as well. So pop down here, other closing costs, now $11,026, and it's dropped slightly because this is where we have a slightly smaller loan amount, and your loan amount impacts how much your closing costs are going to be in various ways. So slightly lower closing costs, which means with our down payment of 20% now, plus our closing costs of $11,026, means our cash all in that you're going to have to bring to escrow in order to get this house is $117,221. Okay, so whether that's coming from your savings or you're selling an old house and you're getting some equity from that, whatever that is, you're going to need $118,000 to close this deal. So let's go ahead and talk about how much income it would take to qualify for the loan in each scenario. So the way that lenders figure this out, basically they're figuring out how much of a monthly payment can we approve you for. And the way that they figure that out is they look at your DTI, which is your debt to income ratio. And in the calculation I'm about to tell you, the way they figure this out is specifically true for conventional loans, which is what we're looking at right now. FHA is similar, but it is the numbers that they use are slightly different. I'm not going to get into that right now. And then VA, USDA, those are pretty different as far as figuring out how much you can qualify for. But lenders look at your DTI, your debt to income ratio, which is your total monthly debts divided by your gross monthly income. And your total monthly debts, this number up here, is credit card debt, student loan debt, any other debts you have, plus the new housing payment that would result from approving you for this loan. They look at the possible new housing payment, including taxes and insurance. And then they divide it by your gross monthly income, which is your income before taxes. And that number needs to be less than 50%. If that number is less than 50%, then typically lenders will approve you for a conventional loan. One note on this is your gross monthly income is not always what you think it might be. Your gross monthly income, if you're salaried, then it's pretty straightforward. It's easy to figure out. You pretty much just use whatever your salary is. But if you're coming and you whether it's just you or you are applying for a loan with your spouse, and one of you is paid on commission, you work variable hours, maybe you work retail and your hours aren't consistent every week, or you are self-employed, you run your own business, then, or any other pay structure, then typically lenders are going to need to see some history. And the way that they figure this number out is not exactly what you think it might be. It ends up being, it's not super intuitive, and it just that the income is scrutinized and it needs to meet pretty important standards, pretty rigid standards that lenders don't typically budge on in order to approve you for the loan. Now, some lenders have more flexibility with that than other lenders, but if it is not salary, if it's any of those other pay structures, then just be aware that the number that you have in mind for your gross monthly income might be different, and drastically different. Like you might have just started a year ago at your new sales job, and you're on track to hit $120,000 this year in gross monthly income, and that shouldn't be a problem at all. And you can show that because you've made in the first 6 months, you've already made 60, and it's only expected to increase from here, and all that. Like maybe that's all true, but the lender is going to look at that and it has to meet their standards, their pretty rigid guidelines in order to qualify, and so they might end up saying, no, we can't count any of that income, or we can only count the base salary from it, or whatever it may be. It has to meet pretty rigid standards, so just be aware of that. If you have trouble with that, then mortgage brokers specifically have access to several different lenders, so sometimes they can help with that. Mortgage brokers are a great option for that. Talk to another loan officer, whether it's another mortgage broker or just another lender, because sometimes lenders have different standards for what they can use for income, but just be mindful of that. So what that means is, as far as total monthly payment, as far as qualifying for these loans, how much income would you need to qualify for these scenarios? Well, basically, we just take this number, we add any other monthly debts you have, and we multiply it by 2, and that's the number you need to be making at least. That's the number that the lender needs to see as usable income, at least, in order to approve you for this loan. So let's just, I'm going to assume you have no other debts. If you have other debts, you just add it to this payment. But I'm going to assume you have no other debts. I'm going to multiply this by 2, and then basically that's the monthly income you need to be making in order to qualify for that loan. So for the 20% down scenario, that ends up being $6,696 per month. And then for the 5% down, it is $7,998 per month in order to qualify for the loan in the 5% down scenario. Okay, so at least this, you're going to have to be making more than that. So those are, let's see what those are per year. So per year, this 20% down scenario, you'd have to be making $80,000 in order to qualify for this payment, and $95,000 in order to qualify for this payment here. If you want to get a quote on a house that you are looking at and see what the numbers are on there, if you want to see how much house you could qualify for, get a look at your income. Maybe you are in that kind of variable income scenario, and you want to just see, what could I count any of my income? How close am I? Feel free to reach out. We love working with new clients. We do loans in Washington and Idaho. All of our contact information is in the description below. You can find us there. And there's also links there and videos there to reviews and videos to see what it's like to work with our team, see what our process is like. If that looks like it'd be a good fit, we'd love to work with you, so please do reach out.